So let's see how we can build a balanced portfolio with index funds and exchange traded funds, with index funds and ETFs. Building a balanced portfolio with index funds and exchange traded funds. So index funds and exchange traded funds are powerful tools for building diversified, cost-effective portfolios. So both types of funds provide exposure to a broad range of securities, making them ideal for achieving a balanced portfolio. So here is how you can use them effectively, how you can effectively utilize both index funds and ETFs in your portfolio. Number one is understand the basis of index funds and ETFs. You need to understand the basics, of index funds and ETFs. When it comes to index funds, these are mutual funds that track the performance of a specific market index, such as the S&P 500 or the All Share Index in Nigeria here. They are designed to replicate the performance of the index by holding the same stocks, in the same proportion. If the index holds like the 500 most capitalized stocks, the index fund will equally hold the same number of stocks, and at the same proportion. So they match the goal is the objective is to match the performance of the index. So as for ETFs, ETFs are similar to index funds in that they track specific indices, sectors, or asset classes. The main difference is that ETFs are traded on stock exchanges like individual stocks and offer greater flexibility and liquidity. That's the only difference. You can buy, you can buy an index, you can buy an ETF in the market, in the open market, in the stock market, and you can equally sell one in the market. So it provides, a decent level of liquidity. Number two is choose a range of index funds and ETFs. Choose a range of index funds and ETFs. To create a balanced portfolio, it's important to select funds that cover a variety of asset classes, sectors, and regions. Here is how you can diversify. So you have broad market index, and ETFs. So invest in a fund or in funds that track major, market index like the Standard & Poor's 500, which represents the largest U.S. companies, or the MSCI World Index for global exposure. These funds provide exposure to a broad range of industries and are essential for achieving. They are essential for achieving diversification. So we look at bond index. We've considered broader market index funds. We've considered broad market index funds / or plus ETFs in the same portfolio. Now, I want to consider bond index funds plus ETFs in the same portfolio. So to reduce volatility and add stability, include bond index funds or ETFs that tracks government or corporate bonds. U.S. Treasury bond ETFs or municipal bonds funds are good example or are good options for conservative investors. Depending on your risk tolerance, you can make these individual choices accordingly. So you currently have sector-specific funds. So consider sector funds, sector-focused funds or ETFs, such as those targeting technology, healthcare, or energy. These funds allow you to capture growth in the specific sectors without the risk of personally getting involved in stock picking. You don't need to do that. The fund handles everything for you. So international funds, we also want to look at international funds. So in this case, it includes, international index funds or ETFs to gain exposure to foreign markets. This provides geographical diversification, reducing the risk associated with investing solely on domestic market. So you are not tied down to your domestic market. You could diversify, across geographies. You can invest outside your country. So you also you may incorporate, small cap and mid cap funds. Small cap and mid cap funds. So add funds that focus on small cap or mid cap stocks. So these funds have high growth potential compared to large cap stocks, though they may come with higher volatility. They may come with higher volatility. Please like this video and subscribe to this channel. It doesn't cost you anything. Just press the subscribe button, click the subscribe button, and then click the like button. It will go a long way in encouraging me as I bring content of this nature your way. Number 3 is create a balanced allocation. Create a balanced allocation. In this case, you consider risk tolerance. The proportion of stocks and bonds in your portfolio should align with your risk tolerance. So more aggressive sectors or investors might allocate a higher percentage to stocks, as much as 80%, for those who can stomach a high risk. And you could incorporate 80% stocks and 20% bonds. While conservative investors may focus more on bonds, they may have 60% bonds and 40% stocks. It all depends on your risk tolerance, your investment, objectives, as well as your overall goal. So we need to consider diversification strategy. So allocate your investment across various asset classes to ensure no single asset class dominates. A common strategy for a balanced portfolio is a 60-40 split between stock and bonds, but this can then be adjusted based on your financial goals and risk tolerance. So there's need for rebalancing also. So regularly review your portfolio and rebalance it to maintain your desired allocation. For example, if stocks performance outpaces bonds, you may need to sell some of the stock funds and then buy more of bond funds to maintain your balance. Then number 4 is minimize cost and maximize efficiency. Minimize cost and maximize efficiency. So in this case, we may have to do with a low-cost index fund and ETFs. So one of the biggest advantages of index fund and ETF is their low expense ratios. Look for stocks or look for funds, with low management fees to keep costs down. This will ensure or enhance your eventual portfolio return. Fees, actually eats into, investment performance or returns. And as these fees accumulate over the years, you discover that, it would become something, quite, it could be considerable. It could be huge at the end of the day. It might look simple or little at the beginning, but as it accumulates and compound, in fact, even the fees alone will do something tangible for you at the end of the day. So you also look at tax efficiency. ETFs are generally more tax efficient than mutual funds because they are structured in a way that minimizes capital gain tax. when selecting ETFs and index funds, consider the tax implication of your investment. Don't just go ahead and select or pick or choose. Consider tax implication on that particular investment. In conclusion, index funds and ETFs are excellent tools. They are excellent tools, uh, for achieving a balanced portfolio because they provide broad market exposure, diversification, and low cost when it comes to building a portfolio, when it comes to investing.